The long-term tailwinds behind gold seem vast, but today we explore any potential factors that could stop the gold bull market in its tracks. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy. So do consider subscribing. Short term, it's certainly possible that we could see some pullbacks as gold does appear technically stretched against the 50 and 200 day moving average here. It's certainly possible we could see some profit taking occur. Moreover, any potential stock market crash could pull gold down, as we saw at around 30% in 2008 or at around 15% in March this year. But gold and silver's tailwinds appear significant and numerous. Just consider the negative real interest rate environment, widening deficits, fueling ever larger national debts, and the currency debasement via quantitative easing, with the Fed's balance sheet going back over $7 trillion. So let's now explore the potential threats that would actually stop gold in its tracks. First, higher nominal interest rates. This first point has already actually been dismissed by the Federal Reserve in saying that they will target an average level of CPI inflation of 2% for the next 5 years or so. They are already admitting to the likelihood of significantly higher inflation down the line. In response to higher inflation, they will not increase interest rates. The crisis has pushed government bond prices to all-time highs, suggesting these assets' reputation for safety remains as strong as ever. But there are good reasons to actually think the opposite, that US Treasuries have lost some of their diversification advantages, and that central bank measures to encourage inflation will be ultimately ruinous for holders of these Treasury bills. While some remain bullish on bonds in the hope of a short-term squeeze, holding government bonds for much lower yields seems far less attractive. Second, since surging in March this year, the dollar index has fallen away dramatically. We can see this decline here, and gold, being the anti-dollar, has certainly benefited from the dollar's weakness. And this has benefited those that have diversified out of fiat. But the recent rebound of the dollar has softened gold's recent gains. Moreover, the arguments for a further short squeeze of the dollar remain. Yet the ongoing deterioration in America's current account position means that more dollars are being sent overseas presently. Meanwhile, the substantial dollar-denominated debt remains, and the cost of borrowing dollars has continued to fall. Of course, a sudden desire to pay off all dollar debts would send the currency surging, but while debts can be easily rolled over, this seems less likely to occur. In addition, the Fed's swap lines with 15 central banks across the world have encouraged some to question how a dollar shortage could ever actually truly present itself. In addition, the M2 money supply has grown at 6 times nominal GDP, or 24.5% per annum. Certainly not the normal circumstances for a massive appreciation in the currency, but we sure live in crazy times, so we'll have to see what lies down the track. And so what do you think? Will people outside of the US use dollars more or less over the course of the next decade? If we can answer this question, we go a long way towards anticipating the likely future direction of the dollar. Yet there remains no suitable contender as things stand, and it takes decades to build the infrastructure necessary to become the global reserve currency. And so what about gold mine supply? Are we likely to see miners take advantage of increased prices to deplete their mines at record rates and see a consequent surge in gold supply, as well as vast new gold discoveries? Well, as we've previously discussed on this channel, miners' low level of capital investment over the course of the last 10 years, together with a desire to reduce their debt levels, has led to a low level of capital investment. Instead, over the last year or so, we've seen miners focus on takeovers rather than expansion of new mining operations. This, together with many highlighting that we're in an era of peak gold, suggests that gold mine production will remain highly supply inelastic. And so what about a rise in real interest rates? Well, with nominal interest rates so incredibly low and the Fed literally guaranteeing that interest rates will not rise for some time, we would need to see an enormous bout of deflation for real rates to rise. Yet with oil prices ticking upwards, labour costs rising and global food prices rising for the third consecutive month in a row, a really worrying indicator. It seems the Fed and other central banks have succeeded in generating the inflation that they desperately want. Yet certain deflationary threats remain present, including the overvaluation of stock and real estate markets. Certainly such markets will continue to receive support from the government and central banks, but a significant deflationary collapse cannot be ruled out. Yet the policy response, given the enormous negative wealth effect that this would cause, would be absolutely colossal and enormously price supportive for gold in the longer term. Another potential threat could include a significant renminbi devaluation. Indeed, the Chinese renminbi has gained significant strength against the dollar recently and is currently trading at around 6.8 to the US greenback. Moreover, China's desire for a greater role and increased status of their currency is not really compatible with further devaluations of their currency. And hedge fund manager Kyle Bass argues that they actually intervene to maintain the renminbi strength. Additionally, further deglobalization and bringing back manufacturing sectors to the US and other Western economies is of course highly inflationary. The argument that quantitative easing is deflationary is put forth by Stephen Van Metre and Brent Johnson suggests that quantitative easing merely increases commercial bank reserves at the Fed and thus does not facilitate an increase in the money supply because bank reserves do not act as a means of exchange. This alternative perspective on QE would seemingly lead to that dollar rebound, potential short squeeze and a fall in gold prices before gold later attains far higher prices commensurate with its deserved place at the heart of the monetary system. We'll investigate the alternative perspectives on QE and what that means for gold and silver in upcoming video. And what chance of an economic recovery? Well, this certainly seems some way off, unfortunately. Just look at the sheer levels of unemployment or significant debt overhang and the dramatic reconstruction and remodeling necessary of our economic systems following this economic crash. And so while there appear significant shorter-term headwinds for gold, the long-term outlook seems clear. The only scenario gold would not perform well in would be in a period such as we saw after 2011 with stalled economic growth of around 1.5% or so, asset price appreciation, yet lower broad inflation. This is the only circumstances where I can see gold underperforming. And so how likely are we to see a period of stalled economic growth and asset price inflation that we saw from around about 2011 to 2020? Well, to my mind, it seems highly unlikely given that market valuations are so incredibly distorted from the actual fundamentals within the stock and real estate markets. But certainly central banks have done all they can to actually increase this distortion within our supposed markets. Yet in asking if anything can stop gold's run, we're really asking whether anything can stop fiat currency's demise. Tellingly, our central bankers have told us through higher average inflation targeting that they actually want to accelerate the demise of their fiat currencies. What do you think? I'd love to hear your take on this. Thanks so much for watching. Do consider subscribing and I look forward to seeing you next time. Bye bye.